The IRS just released tax changes for 2025, and for millions of Americans, they are now going to pay less in taxes to the government. And here's how. First, they increased the ordinary income tax brackets, meaning that for every dollar that you make, you're likely going to pay less in income taxes to the government. The second big change is the standard deduction, which means that the amount of money that you are going to be required to report as taxable income on your return is going to be lower, also saving you money on taxes. The third area is capital gains. So for anybody that's an investor that's buying and selling stocks, real estate, or other assets, this is going to be a way for you to pay less taxes on those gains. And then lastly, for those of you that are savers out there, for things like retirement accounts or 401ks, they've increased the amount that you could put into those accounts. Again, meaning that you're going to pay less in taxes. Today, we're going to dive into each of those areas and provide a simple way for you to pay less in taxes. My name's Luke Turner, co-founder of Moment Private Wealth. We're up athletes and entrepreneurs get smarter with their money. Let's dive into today's topic, the changes to the 2025 tax laws. Okay, so that first piece, our ordinary income taxes. One, let's do a quick brief on how those work. And then two, how are these changes going to help you pay less in taxes? So first, the US tax code works on what's called the progressive system. So whenever you hear somebody say what tax bracket you're in, if you say you're in the 22% tax bracket, that doesn't mean that you're going to pay 22% on every single dollar of income. So let's look at what this looked like in 2024. So in 2024, on the first $12,000 of income, you would have paid about 10%. On the next $40,000 of income, you're going to pay about 12%. And then there's going to be a big jump to the 22% bracket once you make between $47,000 and $100,000 of income. So again, think about these like buckets where we're filling up each one of the buckets. But when you jump into the new bucket, you're only going to pay taxes on the dollars that are in that bucket. Okay. So this goes all the way up to the top tax bracket, which is the 37% bracket, and only dollars over $609,000 of income are going to get taxed at that 37% bracket. But why is this important for you? Well, when we look at 2024 versus 2025, there were some big changes where we see an increase in the amount of money you can make in order to pay less in taxes. So let's look at the 2025 brackets. Now let's look at the 2025 tax rates. And as I mentioned, on the 2025 tax rates, the amount that you need to make to fill up each one of those buckets is higher, which means that you're going to pay less income overall to the government. So let's look at an example of 2024 versus 2025. And let's specifically look at somebody that's making $243,000 versus $250,000. We're using this example because this is the top of the 32% tax bracket. This is excellent to look at because in example one in 2024, if we would have made $243,000, we would have been in the 32% bracket. But if we would have made $250,000 in 2024, we'd have been in the 35% bracket. So now there's an additional $7,000 of income that's going to get taxed at the 32% bracket as opposed to the 35% bracket. So if we look at this example, we look at that $7,000 difference between 243 and 250, that gives us the opportunity to save about $200 in taxes just because of these increases in the tax brackets. So now that we've looked at the ordinary income tax brackets, let's look at the standard deduction. So for those of you that don't know, let's take a quick brief on what the standard deduction is. So the standard deduction is the amount of deduction that every family in America has the right to. So in 2024, that number was $29,200. So if we look at an example, if you made $100,000 in 2024, if we took the standard deduction, the government's now going to take $29,200. They're going to reduce your taxable income. But the big change that the government is making in 2025 is they're increasing that. So for married couples, instead of it being $29,200, it's actually going to be $30,000 in 2025. So again, this is a way for you to take advantage of the tax code and put yourself in a position that you are going to reduce your taxable income just because of the tax laws that are changing in 2025. So in 2025, to summarize, you're going to get about an extra $800 of income that's not going to get taxed because of that change in the standard deduction in 2025. So Now let's look at the third area, which is going to be specifically for investors and tying it back to capital gains. For those of you that don't know, all a capital gain is when you own something, let's say it's a stock, you bought it for $5 and then you sell it for $20. And that increase between $5 and $20 is going to get taxed at capital gains tax rates. Okay, so in that example, you're going to have a $15 capital gain. Now, capital gains get a little bit tricky because there's two different ways that they can be taxed. If you held that asset for less than a year, you're going to get taxed at ordinary income levels. Similar to what we just talked about, we're going to look at those ordinary income tax brackets to determine what you're going to get taxed at. But the trick for capital gains is you want to hold them for over 12 months or over a year. If you do that, you're going to get taxed at what are called long-term capital gains rates. And those long-term capital gains rates, very similar to our ordinary income brackets, they increase the amount to fill up each one of the buckets. So if we look at an example here, let's look at 2024 versus 2025. Okay, so in 2024, if you are a married couple, on the first $94,000 of capital gains, you're going to pay 0% in capital gains taxes. Then at the $94,000 point, you're going to pay 15% tax on those capital gains all the way up to $583,000. Okay, then over $583,000, you're going to pay 20% in capital gains tax. Now, you're probably thinking, wow, that's great, 20% versus if we look at the ordinary income brackets, you're about the 35% bracket. So it gives you an opportunity for what we call tax arbitrage, where if we can hold those assets for over 12 months before we sell them, we can significantly reduce the amount of taxes that we're going to pay. Now, one tricky thing with capital gains tax is that how they're calculated is you first have to look at all of your ordinary income, first, and then you're going to tack on your capital gains taxes on top of that. So what I want to make sure you hear is that if you sell an asset and you have a $100,000 gain, you're not simply just going to apply it to the table you're seeing here for 2024. Rather, you're going to need to make sure you include your ordinary income first, then you're going to tack on your capital gains income on top of that. And that's what you're going to pay taxes on. But that's a topic for another day. So that's for 2024. And then for 2025, let's look at the 2025 brackets here. So in the 2025 brackets, you can see very similar to ordinary income, we've seen an increase in the amount to fill up each one of our buckets, which means that for every dollar of income, you're likely going to pay less in income taxes in 2025. So in 2025, we can earn up to $96,700 in capital gains before we even jump into the 15% bracket. So that first set is still at 0% up to $96,700. We've seen an increase there. In the same way for the 15 to the 20% bracket. So instead of it being about that $583,000 number, now we're up to $600,000 before we jump into the 20% bracket. So understanding these tax laws and understanding when you should buy or sell an asset based on taxes is going to be very important to make sure that you pay the least amount of taxes you can in 2025. So that's capital gains taxes. And now the last piece is going to be our retirement account. So for those people that are out there saving money into retirement accounts, as a reminder, a retirement account, one of the biggest benefits is that when we put money into those accounts, we can defer those taxes. So let's look at a 401k as an example. In 2024, you could contribute $23,000 into a 401k. But in 2025, that's been increased from $23,000 to $23,500. So now there's an additional $500 in taxes or in income that we could defer in 2025 if we wanted to max out our 401k. And if we're in the 37% tax bracket, that $500, if we multiply that by 37%, it's over $150 of additional tax savings that we can get just by taking advantage of these new tax laws in 2025. If you enjoyed this video on taxes, in the description below, there's another video that I think you might like, where we talk about some more in-depth topics related to tax planning. And if you haven't already, please subscribe to the channel. We're going to be putting out videos on a regular basis and would love to have you along for the ride.